my senior colleague and the president of this function, Sri G. Narayan Swami, Mr. B.S. Raghavan, who is retired but never tired about the public responsibility which he has imposed upon himself. My junior and a colleague who gives me the confidence that people like me can retire and he will carry on the job more articulately and more profoundly than any of us can do. And Mr. Srividya Shivakumar, whom I heard for the first time today, and Mr. Shankaran, whose speech I missed. I partly heard Mr. Raghavan. For some of us who have been keenly observing the direction in which this world has been going in the last decades, what has happened today is not much of a surprise. The only surprise element for a person like me is that it happened 2 years ahead of what I thought. See, the issue is not one of system. It is not an issue, according to me, of regulatory imperfections. According to me, it is not an issue of ethics, because I have a different view on the ethical implications which Mr. B.S. Raghavan tried to introduce into the present system. Because once you make greed the god of economics, ethics cannot play a role in that economics. And Keynesian model, which is actually a crisis economics, actually has been made regular economics. The only difference, as Mr. T.C.S. Srinivas Raghavan put it brilliantly in the Hindu business line about 4 or 5 days back, which is one of the most profound articles I have come across on the front page of any newspaper, that the Keynesian model was that the government should undertake investment responsibilities to put money in the hands of the people as income and make them spend. But the model today is you must make the people borrow money and spend. That's the difference. There is a huge difference. You are making people earn and spend, even though the employment opportunity provided may not be useful to us today, but may be useful tomorrow. But you are making people borrow money, you are finding ways to lend money to people, and this has been going on for quite a while, maybe for about a decade and more. And the consequences of which could never have escaped a keen mind looking at the behavior of human beings. It is not just a failure, as I said, of a regulation. And for 2 years, many great minds articulated and differed and debated whether it is slowdown or a recession. 2 years they kept going like this. When everyone knew it was heading towards a collapse. And even today, there is shyness in admitting, there is apprehension in admitting, there is a fear, and a frightened world is refusing to admit that what is happening today is the collapse of a model. And I will try to make good what I am saying. It is not one of those recessions and depressions. If you look at America of 1930s, when depression economists lifted America through very powerful government action. Now today this Fannie Mae, Freddie Mac and the housing companies collapsed. These were all the originations of depression economics. The government itself undertook the responsibility of lending money. The treasury operated the housing loan operation till about 1968, when Lyndon Johnson, because all these were accumulating as part of the fiscal deficit of the government, he privatized, he corporatized the what is called a kind of housing department, assets and liabilities into housing loan company, and then privatized it, created, America always needs one competitor for another, and so they created one Fannie Mae and Freddie Mac and made them compete. But still the entire operations of these two companies were supported as if they were government companies, though they were not. And the whole world was made to lend over $5.2 trillion to these two companies. I will come to it later. Only one point I want to make: their capital is only $80 billion, and the assets and liabilities disclosed in the balance sheet is only $800 billion. Just 1:10 is their asset and debt to capital ratio. But the off-balance sheet liabilities taken means a leveraging ratio of 95 times. This did not come about in a day. It did not come about accidentally. It was a deliberately worked up, legitimate economic model which America followed. America was forced to follow because of the sociological, political, and therefore economic developments in the country, which is what I want to make it to say. Whether what America did was good for America or not itself has become questionable, but we always held the view that such a thing would never have become acceptable or appropriate for India. They said it is a liquidity crisis, but from the beginning it was an issue of insolvency. You can never transpose an insolvency issue into a liquidity issue. And still 2 years went by on this debate. It's just a liquidity, there is tight liquidity, there is tight liquidity. And we believed it because Americans were saying it. The entire crisis was concealed in less dangerous words. They did not want to create a panic, and I could understand, but if there was a remedy at work before the panic could unfold. There was no remedy at work. Actually, there were all efforts to accentuate the crisis, balloon up the crisis, even in this interim period. That I will come to when I am going to deal with America. Many people think that it is a global economic crisis. It is no economic crisis at the global level. It is a American economic crisis exported to the global level. And it was exported by the process of integration with America under the garb of integrating with the world. The German foreign finance minister said that we need our own model today. The same way as he was talking to the German parliament, at the same time, the French President Sarkozy was addressing his constituency. He was addressing 10,000 people in his constituency, and this gentleman was addressing the German parliament. And both were speaking in the same language as if they had a telepathy or a teleconversation. They said that we have been cheated into this model. This model, Anglo-Saxon model or the Anglo-American model, is unsuitable to us. It is unsuited to our way of life. It is unsuited to our belief. This system will not work for us. But they were forced into it, far more than we were ever forced into it, far more than we ever accepted to be forced into it. The entire Europe was forced into it, with the result today. The US is having a bailout package of $700 billion, but the European Union is having a bailout figure of $4,000 billion. They have done nothing for them. They have committed no sin. For them to have a bailout package of $4,000 billion, except that they believed the American system and began investing in American market. Their entire pension fund or their retirement benefit fund or whatever the long-term funds they had, their insurance companies, they began investing in this great market circus which is going on as the most perfect mechanism with an invisible hand which nobody knows whether it functions or is paralyzed. So now we are going to not the system but the model. When the model is okay, you can systematize it. When the model is bad, however much you systematize it, the model is not going to survive, and that is the condition today. The US was planned into this crisis. I will give you a small model by which this crisis developed. The US is a country which is praiseworthy for having undertaken to stabilize and institute and run a global monetary order after the Second World War by pledging its gold to defend the dollar, to make the dollar a stable currency of the world, and for all the world currencies to relate to dollar in a fixed manner. It went on for 20 years. If you look at the statistics of the world between 1950 and 2008, it is only between 1950 and 1970 the world had equitable growth, equitable employment, equitable distribution of wealth, and a faster rate of development, sustainable model. And in 1970 the collapse occurred, things went out of the control of America, black market in gold developed. First, America had defended the dollar by pledging the gold and saying that anyone paying $35 can get 1 ounce of gold from the American Federal Reserve System. In fact, there used to be an exotic estimate. If the gold that America had been reduced into a rope of half an inch thickness, it would go around the world thrice. That is the extent of gold stocks America had. But they pledged it in the interest of the world, and that is why America had a moral position in the world. No other country would pledge its assets like that. For instituting a global monetary system, America did. It had the philosophy to do it, it had the political will to do it, it had the ambition to do it, it had the military power to do it. And so you could understand America assumed the natural leadership of the free world, despite the fact that there were competing forces in the Cold War. America had the legitimacy of global leadership, despite the fact that American policies were not always appreciated. From 1970, the situation changed. America finds it difficult to defend the dollar. It dumps the dollar and says, we will no more give gold in return for the dollar. Dollar is no more gold, gold is no more the dollar, dollar is just a paper. But the world accustomed to dealing in dollar, in the absence of an alternative, had to continue to deal with the dollar which was not defended by gold. That's where the crisis starts. Then currencies are plotted against each other. Currencies are traded only commodities. So the denominator itself becomes a difficult thing to identify. The crisis slowly begins to evolve from there, and they wanted to minimize the effect of the crisis by substituting a theory in place of gold called Washington Consensus. Most people have to understand that Washington Consensus was a theoretical substitute for gold standard, and they said if a country maintains its balance sheet well, if it borrows, if it doesn't borrow much, if it does not have inflation much, if it is able to live within its means, its fiscal deficit is under control, then like the shares of a company or value, the currency of a country will be value. This is how they began equating the currency values, and the currencies began to be traded against each other. And a new economics started, what was called the post-Bretton Woods model started. Even that would have functioned well, but for the fact that America found it was impossible for America to have a dollar operating in America. Only on these principles, they had to do something more and see what they do. In the year 1980, the bank deposits in America carry 23% interest. If somebody gets 23% interest, he will go nowhere near the stock market, and no Americans went near the stock market. Only 5.6% of the Americans were hooked to the stock market in the year 1980. And the rest of the monies were in bank. Their bank was like our bank, commercial bank, accepting for the purpose of lending or investment deposits the money from the public. It was precisely the banking system in America as it is here today. Then they find it is impossible to maintain the growth rate of America when America cut down the inflation from, at that time the running rate of inflation was in America was 12-13%, and they cut down the interest rate, brought it down. Well, Paul Volcker was the US Fed chairman, he was probably one of the best minds who handled this issue, brought down the inflation to something like 4 to 5% and handed it over to Mr. Alan Greenspan in the year 1987. Afterwards, America assumes a role, inherits a model, internalizes a model, which was a dynamite which was evolving in greater and greater destructive proportions. The interest rates began to be cut later. From 23% the interest rate is cut to 8% in 1990. And 25% of the American households are pushed into the stock market, from just 5% to 25%. The interest rate is cut from 8% in 1990 to 1% in 2001. 55% of the American households is pushed into the stock market. So the integration between households and stock market were almost complete. So the consumption economy and the financial economy have come together. Not that. The insurance pension funds, which used to invest in government securities in America or outside America, and they had about 4 to 5% investment in equity in the 80s. Their investment in equities went up to 60% by 2000 into the stock market. So retirement benefit funds, pension funds, very large part of the insurance funds and the household savings were invested into the stock market, and stock market became co-equal with the American economy. It is not the case in Germany. It is not the case in Japan. It can never be the case in India. Unless we understand this, we cannot understand how India is decoupled, how Germany is decoupled, how Japan is decoupled. Japanese have the largest savings in the world, about $12.5 trillion is their bank saving. $2.8 trillion they have only in their postal savings deposit. 56% of their savings is in banks, in which they give for a 5-year deposit 0.8% interest. Still they keep it in bank. They don't go to the stock market. In Germany, when the workers were given equity option, stock option, only 17% of the workers exercise stock option. In spite of a great public campaign done, it is in your interest to own shares in your company. Either give me cash, I will put it in bank. So the entire social security system of Germany, to the extent of 80%, is bank funded. It was called an inefficient system. Japanese system was called an inefficient system because they had not taken to stock market. Only 7% of the German families are linked to stock market. You go to the website of German financial institutions, they say our people do not want to get accustomed to stock market. In India, the same will be stated as the Indian people are backward and so they do not want to go to stock market. No mature economy, no economy with a sense of durability, no economy which has a family background, no economy which an individual cannot play with the money in the way he wants to play with, that economy never gets hooked to the stock market. This is the empirical result that is forthcoming. And you know what has happened in America in this process? There has been a complete integration of the real sector with financial sector with the consumption sector. Anyone with a basic and a keen eye for economics would have understood that by 2001, the American economy had all but switched off with the dot-com collapse. See what happens between 1995 and 2001 and from 2001 to 2006. All this evolved because they found that there is no way by which you can grow on the current assumptions. You have to make future assumptions, draw on the future assumptions, borrow on the future assumptions, project to the future assumptions and get money on that basis. This was called leveraging on future. A model developed in the year 1972. One economist by name Black, he devised a model and that came to be improved later. And one Myron Scholes and Robert Merton improved it further. And by about 1990s, this theoretical model came to be experimented on a massive scale in the stock exchange and financial markets. And the model is that the more debt at less interest you have, the small equity which you will have will yield high return. For example, if the interest rate is 4%, and the rate of return on capital in the industry is 10%. If the entire thing is debt, you will get a 6% return net after interest. But if the debt is 50 and the equity is 50, you will pay 2 rupees on the 50% debt, and the balance 8 rupee will be dividend on the 50 rupee equity. And they said if the equity is 10 and the debt is 9, you get a very high return on equity. And this model was worked to perfection, and they said that there is no risk of loss at all. And they perfected this model, and an institution by long-term capital management was floated in the year 1994 with these two gentlemen, Myron Scholes and Robert Merton being projected as prominent persons, and they were given Nobel Prize in the year 1998 for this grand innovation, and they put their Nobel Prize money into the LTCM. Within 6 months of their putting money in the LTCM collapsed. They lost the money and they went back to teaching. The LTCM collapse presaged what is happening today. But the US Federal Reserve System suppressed the whole thing, got the banks to come together, put together a $4 billion escape, and it was finished. And that model continued, and that is why the crisis today, and that is why not only the US, the whole world is in crisis because of this leveraging model. You know, Bear Stearns, which collapsed, had a leveraging of 1:7 debt. When it collapsed, it had a leveraging of 1:28. You know, Barclays Bank is leveraged 1:62. Fannie Mae and Freddie Mac 1:95. And these are the people who told us, come on, look at the Basel norms. You have to comply with it. Capital inadequacy. The entire government of India completely destroyed the Indian banking system virtually. And today, the unorganized sector doesn't get money from the banking system because of the Basel norms. The only thing they did was their accountants, their consultants, their regulators, as the Venkatesh said, the SEC itself was party to keeping the non-balance sheet items out of the reckoning of capital adequacy norms. Everyone knew what they were doing. And this $5.2 trillion, which Fannie Mae and Freddie Mac advanced and got it refinanced. You see, refinancing is now called derivative. A bank gives money, $100 million to somebody. The bank goes to the IDBI and says, you refinance it. This is called refinancing in the Indian language. Now what the bank does, it converts that $100 billion into what is known as a credit derivative and sells it in the world market. Let's assume that bears an interest rate of 5%. The Japanese banks do not give more than 1% or 2%. They give, as I said, for a 5-year deposit, they give 0.8%. If somebody goes and tells the Japanese bank, this is a AAA rated security and this bears an interest rate of 5%, then the Japanese banks invest in Fannie Mae and Freddie Mac. They have purchased a credit derivative and Fannie Mae and Freddie Mac have gone out of the transaction. Those who have borrowed the money will directly be responsible for those to whom this debt has been sold by way of derivatives. Like this, an internationally transactable derivative market was created and there were insurers for this money. Somebody saying, don't worry, this money will be paid. Somebody saying, no, this debt is such a AAA rated set, I am certifying it, and he is the rating agency. Somebody says, I am guaranteeing this debt, and he becomes the insurer. And a whole chain of intermediaries, some 16 intermediaries were created to transfer the debt from one person to another person without anyone knowing whether the debt is realizable or not. That is how a very large part of the leverage in the debt of America was transferred to Europe. And that is why Europe is in trouble. And when America had this debt relief package of $700 billion, they made a small provision in the law relating to the package. They said this package will apply only to the American banks. But what happens to those banks which have purchased the American debt? Our own bank, ICICI, has purchased a debt of about $500 billion. They are making a provision of $250 billion. American loan mela at the global cost. But how this loan mela came? That is the most important thing. Once you get it, then you know where we stand, where the rest of the world stands. What is the model on which this whole thing has been built, and it is being sold to us. This is the model. You see, in America, by cutting down the interest rate, people were driven, those who were saving were driven from the banks to the stock market. And the banks ceased to be commercial banks, they became investment banks. Because they found that nobody was going to give the deposit, why run the banking industry? So they ceased to do banking business, they became mostly investment banks. The third thing that happened was that people found increasingly that there is nothing called family to live for. The family got disintegrated. 51% of the American families are single parent families, parent by the father or the mother, but not the father and the mother living together. With the result, what happened? Savings plummeted. And you look at the figure of savings of America in the year 1980. If you take $100 as the savings, 80 was the family saving and 20 was the corporate saving. It came down to 60 in 1990. 60-40. Family 60, corporate 40. In the year 2000, family 45, corporate 55. In the year 205, family minus 12, corporate plus 112%. The family got into a net debt of $35 billion in 2005. It got into a net debt of $112 billion. By the third quarter of 2006, the money got transferred by way of consumption expenditure to the corporate profits, and whatever savings the families were making, they got transferred through the equity market into the capital fund of the corporate. In fact, in May-June 2008, when the credit crisis was becoming huge, Alan Greenspan was interviewed. What will happen? Don't worry, our corporates have a $60 billion vault fund and they will be able to manage the situation. Within 3 months, the Lehman collapsed, Merrill Lynch collapsed. Corporates did not part with $1. They said it is our money. Government became insolvent, families became insolvent, corporates became rich. This was the economic model devised by cutting down the interest rate. Whenever interest rate cut is claimed in India, the ultimate destination for this is this. India can never operate on a low interest rate. It has to have a 10% interest rate according to me, because our social security is looked after by families. It is not government which looks after social security. If America can afford a 51% single parent family, it is because the American government looks after the children, governments look after the parents, it looks after the infirm people, and how long they will be able to look after, we don't know, but they look after today. With the result, the families find no meaning in saving. Better live. And not only live by spending, by borrow and spend. There was an economist in India whom we produced some 5,000 years ago. His name was Charwaka. He said the same thing. And somebody was anxious to live well and he didn't have money. Charwaka said, why are you so sunken in your mood? Your neighbor has money, why don't you go and borrow? He said, how will I borrow? I can't pay. Who said you should pay? You need not pay. And he said it is unethical. It is unethical, it is God. Sir, in my next birth I will suffer. Who said that is next birth? Somebody is fooling you. Charwaka commended to our people, you borrow and live well. If you can't pay, say no. He elevated him to the status of a rishi, but he never followed him. But America did it 5,000 years later. The archives of India, you know today, a total number of the houses in America, the functioning houses today are about 98 million is the functioning household. That is renter and owner occupied houses. In America, nobody is in the street. About 98 million houses. That means 9.8 crore households. The total number of credit cards these 98 million households have is 1.2 billion credit cards. Every house has something like 12 to 15 credit cards. And the total credit card debt is 2.8 trillion by 2006. Over and above that, they have a housing debt of $12.5 trillion, of which half the debt is by the government companies called Fannie Mae and Freddie Mac. And these debts were not given for someone to buy the house. It was given for someone who already owns a house, whose house value has gone. For example, I bought a house for 10 lakh rupees. And my house value has become 50 lakhs. I mean, America, nobody buys a house with, see, all of us put together our money, 90% of the money we pay and 10% we borrow. If we are more borrowed, we will put 50% of the money and borrow 50%. In America, people go to a bank and say, I have no money, give me a loan, I will buy a house. And they are given, and there is a mortgage system called jingle mortgage. And the jingle mortgage means they not only give you a house and the house key, but also an envelope. Let's assume after 3 years, you are not able to pay the installment. You need not have to take to the trouble of going and giving the key to the mortgage company. You can put it in an envelope and send it. And say from this day onwards, the house has been locked and the key has been sent to you. I am not responsible for future payment. It is called non-recourse mortgage. Why this system was adopted? This system was adopted to pay, just to put money in the hands of the people so that they will spend. I will give the housing statistics. In the year 1996, there were 111 million houses. Owner occupied 68 million, renter occupied 35 million. The houses unoccupied were 13 million houses. This was 1996. Then the housing companies were asked to lend money to people who build houses, who wanted to buy houses. And when this was done, house prices started moving up. If you look at the graph of house prices in America in relation to the GDP, in 1995, the housing price, the value of the house and the GDP were almost equal. 106% is the value of the houses as related to the GDP, which was 100 to 106. By 2006, the housing value to GDP ratio is 100 to 160, because you began financing house construction and the lands were being bought, materials were being bought, and the prices went up artificially. And anyone who had houses, there was a notional increase in his wealth, and the banker went to him and said, now that your value has gone up, why don't you, I will give you loan against this. And he said, what will I do with the loan? Enjoy your life, what is there? After all, even if you don't get employment, the government is going to take care of you. Can you come across a more irresponsible system of money management? The whole world was seeing all this. And in the year 2005, total houses were 124 million, owner occupied 74 million, renter occupied 34 million, unoccupied 16 million. From 13 million, the unoccupied houses went up to 16 million. In other countries, the housing prices will fall. In America, it rose by 120% in this period. This artificial asset-based economy, lending against it, borrowing, you lend your money, I don't bother. You don't make money. You borrow from the world. And when Alan Greenspan was asked, in the last year, in the month of June, he released a book with fanfare. And he was called the God of Money. God of Money was the title given to him. And in that book he wrote, people talk about America borrowing. But what about people who save? The people who save, they save because they are insecure people. We are a modern nation. We are confident people. And our government is there to take care if we are in distress. We need not have to do any savings to relieve us from distress. And so these people save, and they don't know where they will invest. It is not Bernanke who said it. It is actually Greenspan who said it. And he said there is a global imbalance. There is a surplus saving in one place. There is a money needed in another place. So they have no option but to invest with us. That is how they borrowed the money. And the rest of the world is in trouble because they lent money to America. Out of the total of $52 trillion debt, of all the nations, all the debts of the nations put together is about $52.5 trillion or thereabouts. American debt is $12.5 trillion to the rest of the world. I can even understand America is a huge economy. British debt is $12.4 trillion. And the Anglo-Saxon economies constitute 40%. 5 countries constitute 40% of the global debt. And none of them having any surplus savings. They are all borrowing and borrowing more and more to sustain their household, to sustain their business, to sustain their governments. How could it escape the attention of a keen economic mind? It did not escape, but no one would talk about it. Because to say all this is wrong means the economics is wrong. Yes, the economics is wrong. No one can today come and defend economics of this kind. And in fact, Mr. Rangarajan, a very revered name in Indian economic opinion making, he says in a globalized world, savings in one country and dissavings in another doesn't matter. Then Americans are right. We need to understand that there has been a shift in the American economy, where the initiative has left to the hands of the people, the households, and the government, and it had gone into the hands of a very few powerful corporates. And the US Federal Reserve System is a representative of the corporates. I had openly written about it in Hindu Business Line that the US Fed needs a global watch because its policy decisions are not subject to anybody's scrutiny. The US Federal Reserve System governing body members are appointed for a term of 14 years when the American President's term is 4 years and the American Congressman's term is 2 years. And once you constitute the US Federal Reserve System, nobody can alter it. Not more than 2 members can retire at the same time. So you can understand how the whole model works. The model works by a clique, a very powerful opinion-making clique. The media is under their control. I am not talking of ethics, I am talking of fact. All this is wrong, you can say, but you must say that these wrongs are happening. And how we come out of it, we decouple from that. Decoupling is not happening because of policy. It is not happening because of government. It is not happening because of economic making. In fact, I was explaining to Venkatesh how decoupling takes place in India, within India, and between India and the rest of the world. You take the banking system here, it has very little connection to stock market. It has some connection to foreign exchange market. And the non-banking finance companies have some relation to bank. And the non-banking finance companies are related to the non-corporate sector, it relates to the non-farm commercial sector, it is related to corporate sector, the banks are related to corporate sector, and the stock market is related to corporate sector, and the consumers are related not to the corporate sector directly in India, but only very minutely indirectly. They are related to banks, and you see the decoupling takes place here this way. In America, 55% of the households are linked to the stock market, 100% of the corporates are linked to the stock market, 60% of the government funds in the pension funds and retirement benefits funds are invested in stock market, and stock market is the economy of America. You can understand, in America nothing is, real sector is not decoupled. For example, GM has given a statement, General Motors. It used to be said what is good for General Motors is good for America and vice versa. That was the status of General Motors as a corporate, as the brand of America. They have issued a statement yesterday. If American government is not going to give us cash, we will close down. It has nothing to do with the demand. Because they have sold cars for the next one generation now. They are now trying to sell cars for the people in the womb today by lending money. This model, which according to us was never sustainable for the US itself, was being globalized, universalized, and we were asked to follow that model. This is where our people went wrong. Many things to say, but only one thing I want to emphasize. We need an original thinking for India. Why Indian society? Why Japanese society? Why the German society refuses to invest in stock market? And why still the Indian mind looks at the stock market to decide what is the meter of the Indian economy? Because our mind is controlled by the American opinion-making model. It has nothing to do with the realistic situation in the country. Just 2% of India's savings get into stock market. And Economic Times writes, when India scales 20,000, India has become a superpower because it took 20 years to reach 10,000 and took only 10 months to reach the next 10,000. Of course, it took 8 months to reach back to 10,000. And India is a global power. Just to become, Sensex makes India a superpower and not poker and atom bomb. See how, and when poker and atom bomb was blast, Economic Times wrote, it is the most uneconomic decision. Nobody would have looked at India but for the poker and atom bomb. The economists keep abusing India, the population that India has. If India had a population of only 5 crore, nobody will look at India. How many people know? The people are the strength of India. How many economists have recognized it? So we need a revolution in our thinking. And I conclude my speech as I do in many cases with an incident in the life of Maharishi Aurobindo. When Aurobindo had come to Pondicherry, there was pitch darkness everywhere. Our freedom movement had been virtually snuffed out. Revolutionaries had been finished. There was no voice anywhere in the world. There was pitch darkness. Aurobindo was a foreign educated intellectual. He knew very little about India. But he was looking at a mad mystic called Pullachami, about whom Subramanya Bharati has written poems as to how great a mystic he was. But he was wandering like a madman. So Aurobindo was telling his colleagues, I am going to get some instruction. I am expecting some lead from this man. They were all surprised, this foreign educated, a giant of an intellectual looking at a man who cannot communicate in a language that man only knows. As Aurobindo expected, one day it happened. For months together Aurobindo was looking at him. One day Aurobindo was sitting with his colleagues and having a cup of tea on the beach in Pondicherry. Pullachami came and lifted the teacup in front of Aurobindo and showed it to him. The teacup was full. He emptied it and showed it to him. Aurobindo was in ecstasy. Yes, and I got the instruction I wanted. His colleague said, you have lost the tea. What instruction have you got? He said he has asked me to empty my mind and begin thinking afresh. That is the advice all of us need. Thank you.